Hi everyone, welcome to the Timing Research Show for August 22nd, 2016. My name is David Kosmeter. I'm the creator of Timing Research, and I'd like to welcome you to our 100th Timing Research Show. So during that time, we've had almost 70 trading experts on, and so I'd like to thank all of them for making this a great resource for traders. And during that time, the Timing Research Newsletter has grown from about 2,300 subscribers to now right at 9,300 subscribers. So I want to thank everyone for watching. We have a bunch of people who come back every week to watch the show, and then we have a bunch of new people each week as well. And this week we have Jason Jankovsky on. He was actually on the first episode of the show. So happy to have him on regularly. James Ramelli was on, I think, the 5th episode of the show first. And so, yeah, I'd like to, it's been great having him on as a regular guest as well. Neil Batho was also supposed to be here, but he couldn't make it. He was on the first show as well, so we're going to have him back soon. Christian Fromhertz is a relatively recent addition to our lineup, so happy to have him as well. And of course, Dave Landry. This is his 60th time on the show, so he's been here for more than half of them. So,
wow, you think I know what I'm doing by now?
So Dave is hosting this week, and I'm going to go ahead and turn it over to him.
Thank you, David Kosmeter, and thank you to TimingResearch.com for having me back again. I'm excited to be here for the 100th show. Easy for me to say. Jason Kowski, he's the veteran of the show. Good afternoon, as David pointed out, of the Lion Online. Tell us a little bit about yourself for those of us who do not know you, and tell us a little bit about the Lion Online.
Sure. Well, as I've mentioned, I think last couple of times I've been on, I mentioned that I'm taking kind of a hiatus from full-on education and training of customers at this point. So I'm basically leaving my site up as a place for people to get acquainted with what I do, but I'm really not available for coaching and training and education in the markets right now. But that may change, and I'm focusing on my own personal trading at this point, putting together a program that I think at some point will be very beneficial for people. So for right now, I'm kind of just gracing you with my presence and giving you the full benefit of my sage wisdom, counsel, and advice. And for those of you that are interested in learning more, you're welcome to take a look at my site. Just say hi and hit the email and say you want to join my mailing list, and I'll be happy to keep you posted as to what I do when I do it. But for right now, not really available for additional coaching or training, but open the door to new customers all the time if they're interested. So that's basically the nickel tour on what I'm doing right now.
Okay. James, let's go to you next. James Ramelli of AlphaShark.com, another veteran of the show. Tell us a little bit about yourself and a little bit about AlphaShark.com.
Sure thing. So my name is James Ramelli. I'm a trader and moderator of our live trading room here at AlphaShark Trading. And essentially what we offer our customers is a live trading room and a couple of other lines of products as well, along the lines of education and technical indicators for the Thinkorswim and TradeStation platforms. Essentially what we do all day in our trading room is look for unusual options activity order flow, try to flag that order flow, and then determine, based on that order flow, where institutional money is expecting individual stocks, certain sectors, ETFs, or the broader market to go across any time frame, the end of the week, the end of the month, the end of the year, what have you. Essentially, we build all of our tools and offerings around this idea of following unusual options activity and using that institutional order flow to glean information off of the orders and then position ourselves alongside of those big hedge funds and institutional traders.
Oh, cool. Okay. James Ramelli, another. Oh, we already talked to James, did we? Let's see. Oh, James, did we go to you yet? My order's messed up.
That was me.
Oh, that was you? Okay, yeah. All right, sorry. I need to get everybody to sign in order next time. All right, Christian, let's go to you. Let's go back to you. What direction? Let me give you the actual question. What direction do you think the S&P index will move from today's open to Friday's close.
I don't think Christian got to do his intro.
Oh, we didn't get. Okay, well, Christian.
Yeah, that's okay. I'll give my intro first, and then I'll.
Yeah, let's do. That's what I meant to do with you. I'm sorry. When my order gets messed up, it's hard for me to follow along. So Christian Fromhertz, TribecaTradeGroup.com. Tell us a little bit about yourself. Tell us a little bit about Tribeca Trade Group, and then we'll get to the.
Yeah, sure. And I like the multiple questions first. So yeah, all good. So. My name's Christian Fromhertz, and I'm the CEO of Tribeca Trade Group. We just launched our trading room roughly about 4 months ago, so we're new. I've been a trader for a long time. Started my career at Morgan Stanley as a financial advisor, and then I moved to institutional trading. So I've been a senior trader. I was a director at Merrill Lynch for about 10 years, and I traded on the Delta One trading desk, which if you're not familiar with that, it's a little bit of everything. And I was a senior ETF trader on the institutional side. So, you know, it's very much how my my trading philosophy is. I'm very much a macro trader, and then drills in to smaller trends. So. At Merrill Lynch, I traded everything from ETFs, domestic, international, fixed income, and so forth. And I've kind of brought that over to Tribeca Trade Group. You know, what we do there is we run a very collaborative team environment trading room where, you know, we watch option flow. It's mainly an options trading room. But we build off the room. You know, we're looking to spot trends, and we're looking for, you know, unusual option activity, and obviously looking to make money. So my website is TribecaTradeGroup.com. Also, if you're a part-time trader, we do have things like a swing trading program and newsletters as well. But let me just go to your first question. So what direction do we think the S&P is going to finish this week? You know, I think we've got more in store of this chop. So you know, I think maybe down 0.5%. Really, you know, I know I'm jumping ahead with questions here, but you know, we've got a big meeting on Friday, so you know, I think we're not going to do too much. We may get a little volatility because of low volume this week, but I don't think we're going to move too far this week.
Okay, and rate your confidence to that answer by estimating the probability you have correctly predicted this week's market's move.
Yeah, I would say pretty low. I would say about 60% right now.
Okay. Well, it's not that low. Okay, in the next question, if you want to pull up charts, for anybody who does, I'd encourage you to do that. You can hit the share screen on Google, on the Google Hangouts if you have that up and running. James, let's go to you next to get back in order here. What direction do you think the S&P will head this week to Friday's close on this from today's open? And then rate your confidence to that answer.
One thing I forgot to mention in my opening was that for everyone watching, we're going to be talking about the 152nd report from Timing Research this week. So if you haven't had a chance to take a look at it yet, you can go to TimingResearch.com/reports, and you can download it there and follow along with us.
Seems like it's more about first show than our 100th. Okay, who was I talking to? James, let's go back to you. You know the question, which way the S&P is and rate your confidence?
Yeah. So I think that we're probably going to end the week higher. At this point, confidence-wise, I think it really is almost a coin flip. If we end the week higher, it's not going to be by a whole lot. Just like what Christian said there, they're not going to be seeing a big move this week, and market makers are confirming that. The at-the-money straddles and S&P futures for this week are trading at around 17.5 points, which is nothing. That's what they're saying. We're going to move from today all the way through the end of the week, and you know that doesn't break down to a whole lot of movement on a day-to-day basis. So I think we're probably just going to chop around and grind slightly higher because that's been the trend over the past couple of weeks to do that. But I don't see any big catalysts or breakouts happening this week. We do have some data towards the end of the week. Maybe we get the lion's share of that implied move towards the end of the week. There's also not a whole lot of micro catalysts this week either. We're kind of through the main chunk of earnings for this quarter. There's some retail names, so you know, for someone looking for breakouts or big moves, look for individual names that have catalysts this week or that you see unusual option activity in. That's kind of how I've been setting up my portfolio for the week. I have on only a handful of positions. They're all very short dated, and I probably will look to see if there's any interesting order flow in the retail sector this week, because there are a handful of retail names that are reporting. But other than that, market makers are telling us it's going to be a quiet week, and kind of the lack of data and macro and micro releases confirm that as well.
Okay, and your percent confidence?
I'd say probably about 60%
60%.
chance that we rally. You know, I think it's a little bit better than a coin flip that we end of the week on the upside, because we're just going to chop around sideways for the moment.
Okay, cool. All right, Jason, same question to you, and remember, in the next segment, you could feel free to share charts.
Okay. You guys, well, for those of you that don't know what I do, the listeners that don't know what I do, I focus a lot on the psychology. 90% of what I do is based on the underlying psychology of what's happening, as near as I can determine. And in my view, I think that there's a real strong probability. You know, you can't use the word certainty, you know, where we work on probabilities. But I would say there's a better than 80% chance that the S&P, I think it has the better than 80% potential to test fresh high for the year, fresh high lifetime, maybe the 2200 level by the end of the week. Now, I'll be happy to share with you why I think that, and I don't want to get too far off track with time and all the rest. So if I run long, let me know, okay?
Yeah, well, go ahead and answer the second part of the question, or the third part, which is what procedures do you use to monitor? I'm sorry. The third part is, sorry. For your answer to that, please share your specific reasons you think the S&P will be headed.
Sure.
And in your case, higher.
Okay. If you look at where we started the month, our opening price range, we've spent better than 65% of the month above the opening price range. And on the move lower, which was on the second, that move lower, which by all intents and purposes was the signal that the market had a lot of potential to move further south, because the market was very toppy at that point. All of that selling was absorbed, and the market made a fresh high within 6 trading days and has stayed at that high. It's still at that high. That indicates to me that the professional buyer is still active. If you look at the sentiment that's being presented right now, it shows neutral to bearish for most people, and I take that to mean the public. And I think the public is expecting the market to be under price pressure through these high prints. Now, I think what's really happening, if you look at the volumes that have been going through on, you know, up volume, down volume, and all the rest, the up volume since the sell-off has been mostly up volume, has been higher than the down volume. In other words, if you look at the up bars, compare that to the down bars on the higher time frames, the volume tends to be higher on the up bars. That leads me to believe that the sellers do not have control of the market. The sellers are trying to get positioned, and when the market doesn't make a break, similar to what it did at the beginning of the month, which is what they're basing their point of view on, they're buying it right back. So the seller is not confident that the market has downward potential. I think what will happen is we'll get a surprise of some kind between now and the end of the week, and that surprise will cause the shorts to cover back hard and professionals to grab whatever bids they can on the way up. And I think that we'll see fresh highs. We could see, I think there's about an 80% chance we'll see a try for highs and maybe a test of the 2200 area in the S&P.
Okay, cool. It's very detailed analysis there. I'm going to go ahead and answer the second, all 3 parts of the question, so we can move on here. As far as I don't know if I introduced myself or not. I think I forgot to do that too.
Yeah, Dave, got to get out there, Dave.
I got to get out there. I'm Dave Landry of DaveLandry.com. I believe you can only predict the short term when it comes to markets. I'm in Louisiana. I'm looking at my window. I'm seeing a few clouds. I'm beginning to get nervous. It might start raining again, and it's been raining quite a bit lately if you turned to the news lately. But it doesn't mean it's going to be raining this time next week or a year from now. And I think predicting the weather, predicting the markets, is akin to predicting the weather. You can only look at the short term, and only short-term forecasts are viable. However, the problem is the real money's in longer-term trading, but so is the risk. So I believe you can sort of have your cake and eat it too. I take a bit of a hybrid approach, and I have a 21-page report that's on my website. If you check that out, that explains the crux of my methodology. The rest is just details. So, but check that out if you get a chance. And I'll have some more information at the end of the show on that. As far as the market direction, I'm a trend follower, so I'm not going to argue with it. I'm going to go ahead with up. but I'm only going to give myself 60% confidence in that. And if we take a look at the S&P 500, you could see that it was off to the races for a while, and then we sort of lost steam in here. That doesn't have me too concerned as long as the market can hold these levels. I kind of hate to see it drift upwards, but over the last week or so, we've gone mostly sideways. So I find that a little bit more encouraging than an upward drift. An upward drift is kind of a wedging action, which means the last of the Mohicans are buying, and then when they're done, the market tends to tank. But for now, it looks like we're starting to base it here, and the bigger the base, the further move into space is what I believe. Ideally, I prefer if we just would have busted past these prior highs in here decisively and not look back for a while, but you can't have, I guess you can't have everything, and if you did, where would you put it, right? That's the name, right, with a W. Anyway, it's mostly sideways for now, but as a trend follower, I'm not going to argue with all-time highs, which we just saw recently. Jason could be right, something that could push this thing a little higher. Looks like there's buying every time it dips, so buying comes in. I do think at some point in time, take a look at a weekly chart, I think the buy and hold crowd, who has just bought relentlessly and held on since 2009, at some point they're going to get punished. But as a trend follower, I'm not going to think too much. I'm just going to continue to follow along with new highs. And then, by the way, guys, I'm going to go back to you next, Christian. But we do have one of the new questions for the show is a trade of the week. So if you have a trade of the week, free trade of the week, start thinking about that now. And in the next segment, we'll get to that. Okay, Christian, based on any, please share your specific response, your reasons why you think the S&P will be headed in the direction you've chosen this week.
Yeah, certainly. Let me just grab the screen. All right. So it's basically a combination of factors. You know, a lot of times I look at small caps, and you can see my screen, I would imagine, right?
Yeah.
Okay, good. So you know, so I basically will look at small caps. You know, they're a little bit higher beta. Sometimes they are pretty good at a good gauge of looking at where the market is going to move next. So you can look at IWM, and what I'm looking at here is the weekly chart of IWM, and we're brushing right upon some key resistance in IWM. So, you know, does it mean we're going to reverse? No, not necessarily, but I think we're just, you know, we're possibly due for a little bit of a pullback here. You could also see that we're way above the, you know, this yellow line on my charts is the 5-period exponential moving average. We're way above the 20, which is great. We're in an uptrend. You know, I think that we're going to continue in an uptrend, but you know, I think for more buyers to come back in, I think they're waiting for a little bit of a dip. So, and I think that's evidence. You know, every day I track ETF fund flows, and basically we saw some nice buying in equity ETFs about a week and a half ago. But it's dried up the last 4 days, which, you know, you could take that with a grain of salt. A lot of people are on vacation. Could also be that there's a little bit of a buyer strike going into that Yellen meeting, which is on Friday. So, you know, maybe people are expecting a little bit of volatility there. They want to see what she's going to say, and then they'll start adding money back. In that time frame, kind of just adds to my thesis why I think we could see a little bit of consolidation, maybe a little bit of a move down here in small caps, and then we go forward. The other thing I just wanted to bring up, which, you know, I kind of thought about this weekend, I put out weekly videos. This was the highlight of my video. You know, just looking at what the expectations are for interest rate hikes. Obviously, Janet Yellen's going to be speaking about other things, but everybody's going to be, you know, glued to see if she's going to be talking about interest rate expectations. And this scares me a little bit. If you look at September, it's only 26% probability that is what Fed fund futures are pricing in for a rate hike in the September meeting. Which, you know, okay, if you go out a little bit further, you look at December, you look at February, and it's still only about a 50% probability that they're going to raise interest rates. And keep in mind, this was about 45% last week, so it's a move up. But I do view this as a risk. The fact that the expectations are so low, you know, not that the Fed is actually going to move, but even if they start that chatter about you know, things are lining up for a possible rate hike this year, what this tells me is that the market is not it's not expecting it. And I don't like when the market is not pricing these things in. If the probability was a 75% chance in December and the market's already expecting it, and she says, yeah, we may get one in 2016, fine. The market's probably not going to move that much. But being that it's only 50%, scares me a little bit. So that's the one area that I'm most concerned about. And I think that if we do get that dip coming on Friday, or whether it be Friday, Monday, I do think you'll start to see those buyers come back in, which again, we haven't seen any buyers really come back in the last market. Last thing I'll say, sorry, this is a long-winded answer, I apologize, but be that as it may, as the market's not really moving, as we look at small caps and you look at S&P kind of churning the last 2 weeks, it remains a stock picker's market. You can look at the JCG index, that's the implied correlations. And just like what James is saying, which I echo, is that there's opportunities out there when you have implied correlations in the S&P so low. What that means is that the components of the S&P 500 are not moving together. You've got every day, you've got some sectors up, you got some sectors down. So there's opportunities, and I think letting flow, whether it be option flow, whether it be a big move into a particular sector via ETFs, is the way that you want to play this market. I don't think you just have to, unless you're a complete index trader and just trading S&Ps or futures, I don't think you have to sit on your hands. I think you're going to see outperformance just like we're seeing in technology, and a little bit of a rollover in some of those defensive sectors. So thanks. Apologize for the long-winded answer.
No. Good stuff. And I actually, one of the controversies is we don't have enough controversy on the show. But I agree with you. I think small caps are where the opportunities are, and a lot of things that you said absolutely made a lot of sense. As far as the sector rotation, that's one thing that's been pretty amazing, and it's interesting you touched upon that. I fully agree. It's like each day a new sector takes off. One dies off, and then a new one takes off, and then the one that has begun to die off pops back a little bit. So it's kind of interesting to see the ebb and flow of all the sectors rotating around, and not in a major way though. It's just kind of in a minor way. One goes up, one goes down, one goes up, one goes down, and not like a big rollover or one just blasting higher. James, hadn't forgot about you. Based on your answer to question 1, what specific reasons do you think the S&P 500 will be headed higher?
Right. So, like I said, I think we're heading higher, but not in magnitude where someone should be rushing out right now and buying the SPY with both hands. I don't think that you're going to see a whole lot of return on that this week. But one of the biggest reasons that I am expecting just a really boring trading range for a little while is if we take a look at the price action through the last couple weeks of July, we've spent a really long time stuck in a pretty tight trading range. If you take a look at the daily bar, and I'll grab the screen here and see if I can do that. Let's see. Where am I? Right here. So we spent a long time in this trading range, and we broke out. We're sitting right above what is resistance here on the daily chart, and we're caught back into another one, and this range is pretty well established. I think there is opportunities to kind of buy and sell at either end of this range for shorter term types of plays, but you always said to start thinking about a trade of the week here. I haven't put on a trade in probably the last 3.5 weeks, maybe even a month, that wasn't put on as a day trade or a trade that I knew I would only be in for a couple of days. Been trading a lot of really short dated weekly options. So what I'm looking for is opportunities in individual names. I really don't think that there's a whole lot of opportunity to trade, an indice right now, unless, of course, we're looking at something that's not the S&P 500. I do agree with what was said already about small caps in the Russell. That'll break out first. And it actually looks like it's setting up a lot better for a move to the upside. So what I'm looking for is strength in individual names or sectors dictated by order flow. We have a really flat S&P today, but we're seeing Starbucks up 1.3%. There was some really interesting order flow this morning. We caught some call buying and weekly options that expire on Friday. A trader came in and bought the 55 half calls for 41 cents. In this name, and they've already traded as high as 57. So those are the types of opportunities I'm looking for. I need to find strength in individual equities or sectors, and that strength is going to be where I'm looking for. That strength is going to be dictated by flow. I took a trade in this and have some nice profits already today. But as far as the broader market goes, that really cheap at the money straddle, and the fact that we have a really well-established trading range is why I think we're in the situation where there's about a 50-50 chance, maybe slightly higher chance that we move to the upside, like I said, between now and Friday.
Okay. Looks like that volatility might be compressing in a variety of ways. If the options are getting cheap, then we could be seeing a big move soon. Let's go to, maybe later, but it seems like it's starting to cook a little bit. Christian, let's go back to you. What procedures do you use to monitor and evaluate your trading results and progress over time?
Wait, hold on a second. Dave, before you go to Christian, can I segue what he said earlier and what James just said regarding the specifics? Why
no,
I think the market might. I mean,
no.
Okay, I'll wait. Okay.
No, go ahead. Go ahead.
For a minute, I just saw my dad's face there.
No, go ahead. Go ahead, Jason.
Yeah, I wanted to just jump in and throw this out there. And I agree with Christian that I think the market is waiting, or most traders are waiting for a dip. But I think they got that on the early part of the month. I think that was the dip. That was the extent of it. I think that he's right that the market does need a correction lower. I don't think anyone would disagree with that. But I think they got that dip earlier in the month, and since most people are holding their trades longer than 2 to 3 weeks, the professionals are in for the longer haul. I really think they're saying that the interest rate projection for no rate hike, 20% chance of a rate hike sooner rather than later, and it's only 50% by the end of the year. I think that means that most professionals that are managing larger blocks of money, and that's really what moves the market, is they're looking at the next cycle for earnings before they decide they want to back off on the bull. And I think they don't believe there's going to be a rate hike this year. And so that gives them through the end of the year, about time for the next earnings cycle, and then the election before they have to really adjust positions. So I think they're comfortable. I think they're buying dips with remaining equity, or if they happen to pick something nice and make a nice windfall on it, they can reallocate that to their base position. And I think that the real issue here is the public thinks it's a high. And I think that process is going to have a surprise to it. I think that the public is expecting that we're going to get a bearish reaction on Friday, and I think that they're going to get caught red-handed. That's what I think. And that's just my point of view based on the volume.
Okay. Good stuff. Christian, let's go back to you. What procedures do you use to monitor and evaluate your trading results and progress over time?
Yeah, sure. So there's a couple different methods that I use, and I'll use these for the different types of trades that I do. We do, at Tribeca Trade Group, we do a lot of day trading. We do a lot of swing trading. We also do earnings trades. So I'll look at a couple different measures. Return on investment is really how I'm measuring how successful we are at trading. The other thing I'm also looking at, just from kind of peace of mind, a lot of what kind of trading results or trading, I always kind of foot to a little bit of baseball, actually. Things like batting average. So I'm looking for in my trades greater than 50% winners, which is not always the best measurement of trading results, but for me, just psychologically, what I'm looking to do is, if I can't hit greater than 50% winners, then I shouldn't be trading that trade anymore. So, and it kind of goes, if you're making trades and you're making winners greater than 50%, by default, your return on investment is going to be pretty good. So we'll break that apart in those 3 different buckets of trades. So, for example, for earnings trades that we did this quarter, I'll basically put everything in a spreadsheet. It's one kind of limitation that we have in our trading systems is, it's very hard to measure. You could see what your overall P&L is, but you don't know whether or not you're doing really well in your earnings trades or your swing trades or your day trades. So, I will actually record all of our earnings trades. For return on investment going into last week, we were up 43%. We also had that was return on investment. We also had a winning percentage of over 50% there. So I know, this gives me a feel if I'm not getting the right results, if I'm not hitting those benchmarks, then there's something wrong with my trading system, and I need to tweak my model of what I'm doing in order to get to the place that I want to be in order to get that right batting average, just like a hitter does in baseball. And then also same thing with swing trades. Someone just asked me, a few weeks ago. They said, "Hey, what's your P&L on swing trades?" And I said, "You know what? I don't have the exact data for my swing trades, but you make a good point. Why don't I start breaking it out?" So we actually just started a brand new swing trading program where I'm now recording all the trades in a spreadsheet. I used to run a swing trade program about a year ago where I think we had a return on investment of about 60%. So it goes back to, it was a great question that I had, and I was like, you know what? I need to make sure that I'm getting to where I want to be. So I think that monitor process is really key and really clutch, because if you don't monitor what you're doing in these specific trades, you don't know if you're improving as a trader. And I've been doing this for a long time. I've been trading since, sorry to show my age, but back to 1998. And it's always different. There's always things that you're going to do to get better as a trader, and there's mistakes that you're going to do. But if you don't frequently monitor what you're doing and why you're doing it, and what the reason why you made the mistake is, it's highly unlikely that you're going to remove that mistake or get better at it.
Okay. James, you're up next. What procedures do you use to monitor and evaluate your trading results and progress over time?
Yeah, so
Is anyone else not hearing James? We'll go to.
It looks like his died or something.
His mic off. He might have his mic off.
Maybe a squirrel got his nuts caught in the wire somewhere between us and him. Jason, in the meantime, let's go to you. Poor James is over there talking away. Jason, what? Oh, he's back. He's back.
Okay.
Sorry, hey, James, you're back.
Can you guys?
We lost you for a minute there.
Can you hear me now?
Yeah, we can hear you now. You want to? You have to start from the top. What procedures do you use to monitor evaluate trading results and progress over time?
Yeah, sorry about that. So I was probably talking for about 45 seconds there with none of you guys hearing me, but that's okay. So what I was saying was that very similar to what Christian said, I have different strategies and different plans that I'm trading at any given time, right? And it's important to kind of understand, what I think is an acceptable return in one versus another. I'm never going to be making I shouldn't be making a higher ROI on my day trades and my swing trades, right? My return on risk might be a little higher, but in terms of total invested capital, that's going to be small. So what I need to understand is that, my win rate in each of those subsets needs to be, can be different as well. For earnings trades and catalyst events, things around unemployment, the oil number, individual earnings, I am trading spreads for the most part. And typically, for a spread, I want to have at least 2.5 to 1 on my risk in terms of potential reward. And a lot of strategies that we look at around earnings, it's much higher than that. For call flies and put flies around earnings, I can sometimes get 7, 8, 9 to 1 on my money if the stock goes to a level that is pretty specific. So I don't need to have a 50% win rate or anything above 50% win rate in those types of trades, because if I get one right, it's a home run, and I can be wrong a little bit more often. But I can't apply that same type of tracking to my day trade setups. If I'm not making money in more than half of them, then I'm doing something wrong. Same thing for swing trades. So it's kind of important for me to track my progress that way. Like I know last week was kind of a sideways week for me for earnings trading, but I made money overall because I had 1 or 2 nice day trades in there, right? And when I say sideways week, I take a look at all my earnings trades that I have on, and I can figure out where I made money, where I lost money, and come up with a net P&L for the week. I made a couple $100 overall in earnings last week, but most of the profits I had were from day trade signals. And I think it's important to kind of keep track of that, because when we get into a market environment like we have now, where volatility is really low, the market's choppy, some things are going to stop working, some things are going to work better, and it's important for me to realize where my plan is working and where it's not. I know now that earnings has been tricky this quarter, and being long premium or implied volatility over a longer period of time has been a terrible play because vol keeps coming in. We were talking last week, me and the rest of the moderators in the trading room, about how difficult it is to get long stocks right now with calls because every day vol comes in, and even if you see a nice move in those stocks, the calls aren't reacting as well as they should be. So what does that mean? Time to focus a little bit more on day trading, shorter term types of options where that's not as much of a concern or a factor because you get higher gamma and shorter dated options. The moves are going to make the options more responsive. So, very similar to what Chris said, I think that's really important for people to kind of realize and break your trades up. I mean, I know a lot of traders that just have their position sheet and they have everything in one big pool, but I don't think that's a good way to compare different methodologies because they're so different and the inputs and signals that you're taking are so different. You're never really going to learn anything about your trading plan and yourself if you don't do that type of distinction.
Okay. Okay, Jason, same question. Let's go to you next.
Okay. Well, I do something that's a little more unique, and I do that because I've been trading for more than 30 years. And what I do to manage my daily participation is more focused on record keeping and exploiting the opponent. In other words, I don't care which way the market goes. I care that I'm on the right side of that move when it happens. So in order to do that, I have to approach what I do slightly different. So what I do is I have a long-only account and I have a short-only account. And I manage them completely separately. So when I have a buy signal appear from my approach, I put that trade in the long-only account and manage it completely independently. When I get a sell signal in that same market, I put it in the sell-only account and manage it completely independently. So I'm really price agnostic. So what will end up happening, and this is just a typical week for me, is I'll get a buy signal in a particular currency. I'll put that trade on. It'll start to work, and I'll roll my protective stop to break even. Then I'll roll it to lock a profit, and then I'll get a sell signal, and I'll put the trade on the short side. And the market, let's say it corrects all the way back to where I got in at. Well, I'm out on my long with a gain of whatever pips I can gain there, and I'm holding a short that I then roll to break even on my stop and lock a profit. So if I get a buy signal, market rallies, then I get a sell signal, then it breaks and makes fresh lows, I've actually taken some money out of both sides. So I rarely have more than 50% winning trades, obviously, because I'm always in on both sides. So what I'm looking for is for some sort of anomaly where the price has gotten too far away from what would be considered the average comfort zone that most traders are going to participate in. So when it's too far away, that's when I buy or sell. And when it gets back to the comfort zone, I'm looking for them, the loser, to reinitiate his losing side, and then that may extend the gain further on one side or the other. And hopefully I'm not whipsawed. In other words, I put a long on, I put a short on, and then I'm whipsawed on both sides, and I'm out with a loss on both sides. That's happened, like on days when, the Bank of England raises rates or European Central Bank starts, quantitative easing. Things will happen. But for the most part, I'm not really interested in which way the price goes. I'm not trying to predict price. What I'm looking for is probability for when the loser quits. Because my opponent, I can't get paid. We're in a zero-sum environment. I can't get paid unless somebody else loses money. So the only thing I care about, I don't care about all those other things that most traders focus on. What I care about is when is the loser going to quit and take his loss? Because when he does that, I get paid. So I'm interested in knowing how the loser plays the game. So that process then drops to my bottom line if it's done correctly. And what I do to make sure I'm doing it correctly is I have exhaustive paper records. I write every single trade down. I have a rule set that I review every single day. I have a trading checklist every time I do a trade. I take all that data and crunch those numbers all the time to look for ways that I can improve my personal discipline. Because if I don't improve my personal discipline, I'm not there when I fudge on the signal. I don't take the signal. Oh, I know what I'm doing. That signal's at the wrong time and place. I'm not taking that sell there. And then what happens is that's the one that moves 400 points this week, and I have nothing on. So the important issue for me is I have a systemized approach that tries to attempt to take advantage of how the loser thinks. Great. And now my main thing is I have to enforce that 110% every single minute of every hour of every day. And so my record keeping is the most important part of my trading. If I don't take records and keep them accurately, I can't tell if I'm breaking my rules. I can't, because in the heat of battle, you get a signal, you put it on, you don't take it. What if you fudge on it? You don't move the stop because you think there's more to go. That's the real issue, is maintaining that discipline. So I tend to be a little bit different than other traders, is that I don't really try to anticipate price action in one direction or the other. I try to figure out where the loser is going to get positioned and then try to stay in until he quits. And when he does that, I'll never have more than about 50% winners, because my long doesn't work, but my short does. And so the net is a growth on the equity between both accounts. So half my equity is in one account, half's in the other, and as long as that's higher on Friday than Monday, I'm happy. And my goal is just to maintain flawless discipline.
Okay, good answer on that. As far as my tracking, as far as the mechanics themselves, I keep things fairly simple compared to some of you other guys here who are implementing multiple strategies. Basically, I'm implementing a swing trade strategy where we stick with positions longer term. If you look on the home page of my website, you'll see it's usually about a week delay, but this is my actual tracking spreadsheet of my daily core trading service. So these are the mechanics, and if it's not highlighted, it means that we've taken a partial profit on that position, and the ones that are still highlighted are still open positions. So in this particular case, in the CNX, this is the open profit on that. So these are the mechanics. Obviously, the mechanics are pretty easy. If you know where you're going to get in and you know where your stop is, the spreadsheet will calculate everything for you. If you want a copy of it, just let me know, and I'll email you a copy. Be happy to do that. Now, before we get into the process of the actual trades going in, I wanted to comment on one thing that I heard today from everyone. Again, not enough controversy, but I like that everyone here came out and said that the percent correct is really not that important. It's important to make money. It's not important to be right. It's important to make money, and when you're wrong, get out the way, obviously. So I think that's very important for people to realize. As I often say, I used to program mechanical systems many years ago, and I could probably crank one out that's 90% correct within about 10 or 15 minutes, but will it make money longer term? Probably not. So don't focus so much on that. Now, the other thing is, as far as tracking trades, it's really a process-oriented type of business. So you need to focus on the process. Did you do the right thing or not on every trade? And if you find a trade that looks really good and you like it, and you took it when it hit the entry, and you put a stop in, and you got stopped out, well, so be it, okay? It happens, spelled with a silent SH, okay? Welcome to trading. Not every trade is going to be right. As I often say, no one knows exactly where a market is headed, not you, not me, not the guy who screams on TV. But if you focus on the process and getting better at the process, get better on your stock selection. Deliberate practice is very important. I don't want to get too far into psychology, but when you're looking at stocks to trade, make sure you have the best of the best. For some reason, people who look for perfection in life, doctors, lawyers, etc., they make the absolute worst traders because for some reason they settle for mediocrity in the market. So work to get better at your stock selection. Work on the process. See it as a three-pronged approach or a three-stranded cord. Mind, methodology, and then, of course, the money management, which we'll talk a little bit about here. Also, money management will cure a multitude of sins. If you're trading at a very small size, that each trade or any individual trade shouldn't make a big difference in your psyche, shouldn't wipe you out or stress you out or anything like that. I was asking an interview a couple days ago what keeps me up at night. Well, it's not an individual open trade that keeps me up because the risks are fairly well defined. Something bad can still happen, I know that. But I worry more about what happens if the market goes flat and chops around for a long time and I'm not finding a lot of opportunities, which occasionally does happen. But other than that, I can sleep well at night knowing that my risks are in line. And then, again, it's not so much the percent correct or how much you make, but it's the process involved. If you make a lot of money in a trade and you really gambled quite a bit, the market has taught you to do the wrong thing. And that could get you into a lot of trouble. Let me just jump into the trade of the week before I forget. I'll wipe that out for me, and then if anybody else has the free trade of the week they would like to share, feel free to get your charts queued up now. I mentioned this one last week, I think, buy above 20. It shot up to 24. And it's setting up again for another trade. We are still long, which you'll see in that portfolio probably in a day or two once I upload the new one to the website. It's taken off in here. It's accelerated hard. It's pulled back. It's not that far from all-time highs. It is a new issue. I'm a big fan of IPOs. I'm a big fan of smaller cap stocks in general. It has gotten a little thin as of late, so this is more for the small private trader as opposed, obviously, to an RIA or something like that. But it can trade with decent volume at times. That's one problem with the IPOs is the volume is a little tricky to figure out whether or not they're thin enough or thick enough to trade. But I think this was still worth a shot. Nice little pullback. Again, we're still long. You'll see the portfolio in a couple of days on my website. So I think that would be worth a shot. Entry, let's say about 23. It's going to take a wide berth, so stop, maybe wait up here at 19. And then if you do the math on that, that would give you an initial profit target of 27. And then from there, you want to trail that stop higher and loosen it up as you go. Again, if you read the article, the free report I mentioned earlier, it'll explain the position management on that. So that's the free trade of the week. Christian, let's go back to you. Do you have free trade of the week? And if not, any closing thoughts about TribecaTradeGroup.com?
Yeah, sure. I'll give you both. I like that.
All right, fantastic.
So, I mentioned in the beginning of the call that we're seeing kind of a sector rotation. We're seeing a lot of money going into technology, seeing a lot of money go into emerging markets, and so this was a trade that I had on last week. This is a defensive sector. This is telecom. This worked out really well. So this set up technically just beautifully a break of the value area. This is on the daily chart, and on our indicators we actually have these lines drawn for us. So this told me exactly where to hit the target in telecom. So what I'm looking at is for a similar move to go on in REITs. REITs have seen between VNQ and IYR just a colossal amount of investment over the last year. I think there's something like over $4 billion that have been added to REITs this year through ETF fund flows. And I'm not going to play VNQ. That's basically been through VNQ. But what I think is kind of happening here is we're starting to see the rotation out of a lot of the over-owned sectors that were very bid up in the beginning of the year, such as REITs, such as utilities. So what I'm seeing technically is just a break below, just like we saw in telecom. We're seeing a little bit of a break below here in REITs, and keep in mind the PE of the whole REIT ETF is about a 35, so I think it's got some downside ahead of it. I think it's a little bit too heavily owned right now. We're not seeing any outflows yet in the group, but I'm just technically watching it. If we come back and retest this green line here, I think we've got a downsized target to this, what's called the virgin point of control, VPOC, down to this 79 level. So that's what I'm watching there. That's my short idea. And also, as I mentioned, it's a stock picker's market. We've been long in our room emerging markets for quite some time. You could see this in terms of also the weekly chart. A move into the value area. Academics of the value area say that once you get firmly into the value area, you could see there's an 80% chance that you'll go from the bottom to the top of value. So I've been long EM. I've been long a number of other emerging market areas. What I'm looking at right now is Shanghai. If everybody remembers, huge volatility last year, huge move up. This I won't even say stairs up and escalator down. It was actually escalator up and escalator down. But we're starting to see a big base that's happening. This is ASHR. This is your Shanghai ETF. Very different than FXI, which is Hong Kong shares. This is local shares. There was an announcement last week that they're putting together a connect for more investors. So what I'm watching is this bottom level here. This is call it 25, 27. So I just did start to go long. I want to make sure that the price action is firmly into this value area. So if it pops straight out, I can get out of my little trade. If we start to get a further grind up here, then I'm going to increase my position going long ASHR. Again, that's one of the few ETFs that you could play actually Shanghai or A shares in China. So that's what I'm looking at. Still going long emerging markets and selling those defensive sectors. And then finally, you said what's going on over at Tribeca Trade Group. If you're unfamiliar with these lines, this is volume at price. We're actually giving a webinar on Thursday. You can get the link on our website, TribecaTradeGroup.com, or on my Twitter page, and it's on the blogs and video sign. You can sign up. I actually have the architect or the developer who's put together this value area study, and he's put together over 1,100 lines of code that are in this indicator, and he's done this. There's 4 versions that he's basically gone through to make this better and better. So we're going to be going over that on Thursday night. If you've never heard of valuary studies or things like VPOCs, this is something that I never traded with when I was an institutional trader at Merrill Lynch. But once I got turned on to it, I live and die by this stuff. So, please join us Thursday night. And sorry for the plug again. But
no worries. No, I'm not a big fan of volume, but I recently said in an interview with Stocks and Commodities that if I did have to use volume, it would be volume and price. So it's kind of cool what you're doing over there. Just real quick, I thought I was sharing my screen, but I wasn't. Yeah, the trade is PI, and then I think it said an entry about 23 with a target of 27. And a stop around 18, kind of a wide berth. It's an IPO. Once you get the spreadsheet I mentioned earlier and you punch this in, you'll see what happens is with these more volatile stocks, such as an IPO, the number of shares you're trading goes down tremendously. In fact, if you dig around my website, there's an article, Better the Devil You Know, and I talk about or make a strong case for trading more volatile stocks versus less volatile stocks. And believe it or not, it's a little counterintuitive. A more volatile stock can be less risky because you're adjusting your share size down, and something bad could always happen in a less volatile stock. Okay, James, let's go to you next. Do you have a free trade of the week?
Yeah, so I actually am looking at a individual stock here, and the stock that I think presents the best opportunity for traders this week, let me share my screen really quickly, is HBI, Hanes brand. If I really had to say what my most confident trade was this week, I would say that it's the Starbucks day trade that I have on right now. That's already starting to work out really well, but, I think the best setups are going to be day trade setups. But if someone is looking for a swing trade, I think Hanes brand is some of the best order flow we've seen in a while. On Friday, a trader came in and bought a huge position in the HBI SEP 29 strike calls, which is a little out of the money right now. And what I like in the chart of HBI here is that we haven't really seen the stock participate and make new highs yet. The stock got absolutely crushed on earnings not that long ago, the beginning of the month, has filled that gap up completely and then some, so has taken out the highs of the trading range it had been in before earnings, and now we have institutional traders coming in and making some really big bets. There's over 8,000 contracts in open interest on that line now. The trader that bought them on Friday paid 45 cents for them, but they're 40 bid at 45 now. They actually closed Friday's session 50 at 55. So anyone that caught that signal but was waiting for the price to come back in a little bit, that didn't want to pay up to get into these, it did that today. They're back at the trader's entry price in HBI. You can actually see the alert here at the top of the screen on the left-hand side. They came in. It was over 6,000 of those bought for 45 cents. And that's, HBI is not a stock that you typically hear them talking about on CNBC. It's not one of those names that is always on the forefront of everyone's mind. So when you see a big aggressive trade like that in what is a relatively short-dated position, the options expire in 25 days, it's something to take note of, particularly with the chart setup that we have here. We're breaking above the Ichimoku cloud, have more than taken back the gap lower from earnings, and I think it looks really strong and is a good swing trade opportunity for someone who's looking for one.
Okay, cool. And I'll come back to you on the wrap up. Jason, do you have a free trade of the week idea?
Oh yeah, I got a huge one.
All right, let's hear it.
Okay, as you probably know, I trade currencies for the most part. And this week, well, I should say Friday last week, and Friday the week before, the CFTC Commitment to Traders report showed a record short position in the British pounds. Now, more people are short British pounds at a 30-year low than have ever been short in history. That's a recipe for a rally.
Yeah.
Okay. I would buy any pullback that holds the 130 level. A test of 128 still isn't out of the ballpark, but if you're willing to be patient, if you're willing to, and not everybody buys right perfectly, you might have to try 2 or 3 times to get positioned. But if you get positioned and can get 80 or 100 pip lead on something by the end of the week in pounds, I would be really strongly encouraging you to hold that and look for places to add to that position on further pullbacks. Because I personally think, because I've seen this a million times, when markets reach extended levels of participation on one side or the other, the probability of a reversal is above 90%. And I can tell you from personal experience, having watched these trades develop time after time after time, that it's only a matter of time. So if you can get positioned and stay there, it's not that you can't see another increase for 2 or 3 more weeks of a record short.
Yeah.
But if no new low happens during the time when another record short happens, that it's going to fly. And you could easily see this market put on 500 or 800 points in a week or two. And that may not mean that the bear move is over, but I mean, if our goal is to close out Q3 with a windfall and put our equity in levels it hasn't been at in all year, why wouldn't you take their money?
Yeah, I have to agree. You know, I'm a trend follower, but I have to agree with you on that. And what I've been doing is taking a few trades on hourly bow ties, which is just a moving average crossover method, and you can find that in free reports on our website. It's real simple stuff. But I've been watching the hourly charts and playing a few reversals there. Make a little, lose a little, but I think that's possibly where the money is. I can't argue with you on that. Yeah, I'm not a big forex guy, but I prefer stocks because they're inefficient. But I do think I think you're onto something there, so I have to agree with you. Yeah, go ahead, Joe. Go ahead.
Can I just take 2 seconds longer and tell you, one of the things that helps him with the whole psychology issue to get positioned on trades that have this kind of potential is watching the public available news. And I'm watching CNBC every day now for when, can I say this without running the risk of a lawsuit here? When Dennis Gartman is on. It's not my show. Okay, when Dennis Gartman is on, I call it the Gartman indicator. The guy is phenomenal at calling turns in the market. If Gartman comes on this week or next week and says that he is selling British pounds on rallies, I would buy twice the position. So I'm waiting for the Gartman indicator to show up. So I'm just saying, and I don't know if that is a problem for guys in the industry or people would have a hard time with that. I like Dennis. I've met him. I can't tell you how many times. You know, had drinks at industry functions with him. He's a great guy, but there are times when he calls the turn. So if he does this week or next, I think that's a great indicator that the long pound position could really hatch before the end of September. So
well, I don't watch CNBC, but email me when that happens, okay? A little wake-up call. All right, hey, while we still have you, any closing thoughts about anything, and then the lineonline.com?
No, just thanks for having me on the 100th show anniversary. I was here for the first show, and I had an opportunity to be here for the 100th show, and that's been a real blessing for me. Thank you. I've had an opportunity to have some conversation with listeners from the Timing Research Show over the years, and they're all great people, are really trying hard to do this right, and respect that. And as far as, like I said, as my website is concerned, I'm not really looking for new customers right now, but you're welcome to join my mailing list and keep an open door to when the opportunity does. At some point in the future, I may. I don't know. But I'll definitely give you the best effort that I can for anyone who's interested for what time I can give you. And good luck, good trading.
Okay, cool. All right, James, let's go back to you. Any closing thoughts or anything else you want? AlphaShark.com.
Yeah, so we have a lot of different ways that you can kind of get in touch with us and find out a little bit more about what it is that we do. One of the two of the main things I kind of talked about here was unusual option activity and the Ichimoku Cloud. If you go to our website, you actually get a chance to put your email in on the homepage and download 2 ebooks that are actually about those topics. So if you're interested in learning more, that's a really easy way to go do that right now. And of course, I make myself available to all of the listeners of this show as well via email. You can email me, james@alphashark.com. Any questions you have about anything I've mentioned or talked about here, or if you just want to learn a little bit more about the different ways that you can become involved with us and the different offerings we have way too many for me to kind of list out here. But please get in touch with me if you have any questions. And again, thank you to David for having me on the show. He told me last week it was episode 100, and I was thinking that I had been doing this for a long time. I didn't know that I was on number 5 there. That was one of the first couple ones, and I've really enjoyed being on the show so many times since then, and always look forward to coming back because we have some really great discussions here. And I've gotten to know some of the listeners of the show, and the other presenters here has been really fun as well. So thank you guys all very much, and as always, happy trading.
Yeah, glad to have you. Again, I'm Landry.com. If you need to reach me on anything, I do answer my own emails. I have a lot of getting started for free stuff on my website. You can see there's a list of things that go through if you go to getting started on my website, but I also have 1,500 YouTubes out there, and I think over 600 posts on the markets, articles, and market updates, and money management, psychology, and all that is. A lot of that stuff is free, or everything I just mentioned is free, so you can get to know me first before dipping further into courses or by trading services and things like that. I also do a weekly webinar, so if you want to join us every Thursday, we don't take ourselves too seriously. Usually I lecture about what's going on in the markets and maybe do a little teaching for the first 30, 40 minutes, and then after that I open up the show to you, any questions you may have on trading, and also take a look at your favorite stock picks, and that's kind of the fun part of the show. Everybody seems to enjoy that. So feel free to join us in that, and I second what everyone said about the listeners. Great, or the viewers, however you want to look at it. Great bunch of people that are fans of Timing Research Show, so it's been a pleasure for me to get to know you guys, too, on this 100 show. All right, David, thanks again for having me host. It was an honor to be here in the 100 show, so let me turn things back over to you.
Yeah, thanks, guys. Happy to have you guys here for the 100th show, and hope to see you again on the 200th show and many times between then. But so I just want to remind everyone watching that you can go to TimingResearch.com and you can view any of the past shows there if you want, as well as this one in a few minutes, and also you can download any of the past reports. Join us next week for the show, the 101st show. We'll have Mark Sebastian of OptionPit.com, Glenn Thompson of PacificTradingAcademy.com, Cameron Yost of TradingWorks.info, and Alan Nuttman of BullseyeOption.com. And also just want to, again, thank my guests this week. Neil Batho of TraderReview.com was supposed to be on today, but we'll have him on again sometime in the future. Jason Jankovsky of TheLionOnline.com. Yeah, like you said, you're on the first show, so happy to have you.
Glad to be here. Thanks for having me.
Yeah. And James Ramelli of AlphaShark.com. Really appreciate you coming on all these times as well. I think this is your 16th show for you.
16th. I've lost count. That sounds about right, though.
Yeah. And Christian Fromhertz of Tribeca Trade Group. I think it's your third or fourth show, so happy to have you with us as well. And of course,
absolutely.
Dave Landry.
Thanks to be a part of the 100. Appreciate it.
Yeah. And of course, Dave Landry of DaveLandry.com.
Thank you.
Number 60 for you. So thanks. Thanks. All right. Thanks, guys. Great show.
Thanks.
Bye, everyone.